Hello everyone, and welcome back. In today's video, we're going to talk about Olympus DAO. Now, Olympus DAO has been getting a ton of coverage lately, and the reason for that is because they launched a new Pro product, which is meant to integrate with other protocols. Now, I will cover Olympus Pro, but before we get into that, I do think it's important to cover Olympus, just so you know how the basic mechanic works. So as you can see here, Olympus brands themselves as a decentralized reserve currency. Users essentially sell other tokens into Olympus's treasury, and they get the OHM token as a reward for doing so. So right off the bat, we can see here that the Olympus market cap right now is about $3.3 billion, and that is currently backed by just over $412 million of treasury assets. Now, if I highlight over this treasury assets chart, you can see the majority of the assets backing OHM are DAI and Frax, which are stablecoins, and then you also have ETH and Sushi. Now, the first thing you need to notice is that the market value of the treasury assets is less than 10% of the value of the market cap of OHM, which means OHM is inherently under-collateralized. Now, the main reason people are paying a premium for OHM is because of this stake tab here that I'm on now. So users can single stake OHM and receive a very high APY for it, about 7,590% right now. Now, if you're curious, a 7,500% APY is about a 440% APR compounded daily. So definitely something to keep in mind and really understand how much they're paying out in OHM rewards. So the reason Olympus is paying out such a high APY is because, as I mentioned, OHM is trading at a premium to the net asset value. These are called rebasing rewards. Essentially, you would deposit one OHM here and your balance is going to continually increase because OHM is trading at a premium and they're printing new OHM tokens to drive the price down and reward stakers. Now, if you've seen this 3-3 meme around, that is essentially how they're branding their single staking product. They're basically saying that if market participants can coordinate and stake and not sell their rewards, then the price of OHM should continue to go up. Now, obviously, this isn't something you want to take to the bank. Market dynamics just don't work that way. So their next product, which again is the basis of the Pro feature I'm going to go over, are their bonds. Now, the Olympus DAO actually controls most of the liquidity for the OHM token, and it does that because it incentivizes users to deposit LP tokens onto the OHM platform. So the best example is this OHM DAI SushiSwap LP pair. Users essentially deposit into the pair on SushiSwap, and then Olympus says if you deposit that LP token into OHM and give us that liquidity, we'll sell you OHM tokens at a discount. Now I'll just click on the bond tab here for OHM Frax. Again, Frax is a stablecoin, and you can see right now they're selling OHM tokens for people that deposit the OHM Frax LP token for a discount of about 4.2%. Now the important thing to note here is they're paying you out in OHM tokens and they're vesting those tokens to you over 5 days. So all things equal, if the price of OHM does not move, you just purchased OHM for a 4.2% discount as long as you can wait the 5 days to claim those OHM tokens. So now that we've covered how Olympus works, I think we can talk about the Olympus Pro product. So Olympus has partnered with many large apps on Ethereum, and they're essentially offering these bonding products to different protocols. So why would a protocol be interested in purchasing LP tokens from users and giving away their governance token at a small discount? Well, there are actually a few smart reasons for that. And the first is that liquidity in general is often quite parasitic. So the first piece of data that Olympus shares, which I think is pretty compelling, is that most yield farmers deposit LP tokens, sell off the rewards, and then just leave the ecosystem. So they're not really contributing much, they're just farming rewards. And in addition to that, you can see here at the bottom, they also go over more logic on why the bond program is a win-win for both depositors and protocols. So for the community, they get the opportunity to purchase discounted tokens from their favorite protocols, and they're also getting lower risk because they're not getting exposure to impermanent loss. Remember, they're selling their LP tokens just for a governance token from a protocol. Now, from a protocol standpoint, the protocol now purchases long-term liquidity that it's basically going to own forever. So they don't have to continually incentivize LPs to provide liquidity for their governance tokens. They're going to own that liquidity. In addition to that, the protocol, of course, captures the revenue stream from DEX trades, so they're getting all of the fees from the LP tokens that they purchased. This could provide a pretty significant benefit over the long term. So we're on the Olympus Pro bonding page here, and you can see it's all done through the Olympus UI. But you can see their partners here, Pendle, Abracadabra, Alchemex, Frax. There's some large ones here. And if we click the bond page for, let's just say Pendle, you can see that Pendle is selling the governance token for a 4.79% discount as long as you're willing to deal with a 7-day vesting period. So if you were interested in purchasing Pendle, it probably makes more sense, as long as the gas fees cover this, to provide liquidity for this pair, deposit it into Olympus, and then accept the 1-week vesting period, which really isn't too long. So this is obviously not without risk, but I think you are being compensated for your time pretty well for this pool. So you are getting a 4.79% discount, which is great. You can see here that the ROIs fluctuate, and when the ROI actually turns negative, it's best not to participate in the bond market. So feel free to wait if you see a negative ROI like with the Frax ETH pair. So what does the Ohm token and Olympus DAO actually get from this Pro product? I'm on the main Medium post announcing the Pro product, and you can see here that Olympus Treasury takes a 3.3% fee from all bond payouts. So you can see the breakdown here. If an Abracadabra bonder, for example, gets 1 spell, the Treasury receives 0.033 spell. In addition, you can see here that this offers more utility to the Ohm token since now they're in a greater position to work with other protocols to provide liquidity for Ohm or to give other protocols discounts to integrate with Ohm. So here I am on the Olympus CoinGecko, and if we scroll down to the 90-day price chart here, you can see since the Pro product came out, the price of Ohm has done very, very well. So it is impressive to see the Ohm price do so well with all of that issuance from single staking and rebasing. And just to show you what that looks like, if we go to the market cap tab here, when that adjusts here, you'll see the market cap has done incredibly well as well and is sitting at about 3.5 billion. I did want to briefly cover some on-chain analytics from Nansen. So these are the analytics for the staked Ohm token, and again, the vast majority of Ohm is staked because you get all those rebasing rewards. So it makes sense to look at the SOhm token, and you can see here that on the right, unique addresses for this token has really skyrocketed. So at the time of this video, there are over 26,000 addresses that hold this token. And one thing I think is very important to track is the seniority distribution of token holders. So keep in mind that rebasing reward is very high, which means if you stake Ohm and you're able to hold it in there for a while, you're going to get a ton of Ohm due to rebasing. Now we can see that with the distribution here. So you can see that 83% of the tokens are held by 11% of the addresses that have used SOhm for over 90 days. Now that is a bit nuanced, but what that essentially means is that for the last 3 months, a lot of people in this SOhm token contract have been accumulating Ohm and they haven't yet sold it. Personally, this is something I would be very concerned about because these people have stacked a ton of Ohm and have really increased their position size significantly. For those people, it does make sense that for them, they have to unstake at some point and sell their Ohm tokens. Now, I know this goes against the 3-3 meme that Ohm puts out, but I really do think that market participants can't coordinate in that manner, and they do have to sell Ohm for a profit. It's just the right thing to do for them. If you thought these analytics were useful to you, I do have a link below to try Nansen out. So for me personally, I wouldn't hold the Ohm token now, but I do think that Pro program that they're offering is quite innovative. It is very possible that Pro product does see a lot of growth, which increases the price of Ohm. It's really tough to say, but it's something I will definitely keep track of. I do think a lot of protocols are going to switch to owning their own liquidity. This just makes a lot more sense than having to pay out liquidity rewards for multiple years. So I'm definitely a fan of the Olympus Pro product, but probably not a fan of the Ohm token itself. Again, of course, that's not financial advice, and you should always do your own research. Now, I want to thank you all so much for watching this video. If you enjoyed it, please give it a like and subscribe below. Thank you all so much for watching, and I look forward to seeing you all in the next video.